Trading rules. 1. Whenever the trend you are riding approaches support or resistance, tighten your protective stop. A protective stop is an order to sell below the market when you are long or to cover shorts above the market when you are short. This stop protects you from getting badly hurt by an adverse market move. A trend reveals its health by how it acts when it hits support or resistance. If it is strong enough to penetrate that zone, it accelerates, and your tight stop is not touched. If a trend bounces away from support or resistance, it reveals its weakness. In that case, your tight stop salvages a good chunk of profits. 2. Support and resistance are more important on long-term charts than on short-term charts. Weekly charts are more important than dailies. A good trader keeps an eye on several time frames and defers to the longer one. If the weekly trend is sailing through a clear zone, the fact that the daily trend is hitting resistance is less important. When a weekly trend approaches support or resistance, you should be more inclined to act. 3. Support and resistance levels are useful for placing stop-loss and protect-profit orders. The bottom of a congestion area is the bottom line of support. If you buy and place your stop below that level, you give the uptrend plenty of room. More cautious traders buy after an upside breakout and place a stop in the middle of a congestion area. A true upside breakout should not be followed by a pullback into the range, just as a rocket is not supposed to sink back to its launching pad. Reverse this procedure in downtrends. Many traders avoid placing stops at round numbers. This superstition began with the off-the-cuff advice by Edwards and McGee to avoid placing stops at round numbers because everybody was placing them there. Now, if traders buy copper at 92, they place a stop at 89.75 rather than 90. When they sell a stock short at 76, they place a protective stop at 80.25 rather than 80. These days, there are fewer stops at round numbers than at fractional numbers. It is better to place your stops at logical levels, round or not. Markets spend more time in trading ranges than they do in trends. Most breakouts from trading ranges are false breakouts. They suck in trend followers just before prices return into the trading range. A false breakout is the bane of amateurs, but professional traders love them. Professionals expect prices to fluctuate without going very far most of the time. They wait until an upside breakout stops reaching new highs or a downside breakout stops making new lows. Then they pounce. They fade the breakout, trade against it, and place a protective stop at the latest extreme point. It is a very tight stop, and their risk is low, while there is a big profit potential from a pullback into the congestion zone. The risk-reward ratio is so good that professionals can afford to be wrong half the time and still come out ahead of the game. The best time to buy an upside breakout on a daily chart is when your analysis of the weekly chart suggests that a new uptrend is developing. True breakouts are confirmed by heavy volume, while false breakouts tend to have light volume. True breakouts are confirmed when technical indicators reach new extreme highs or lows in the direction of the trend, while false breakouts are often marked by divergences between prices and indicators. Traders try to profit from changes in prices. Buy low and sell high, or sell short high and cover low. Even a quick look at a chart reveals that markets spend most of their time in trading ranges. They spend less time in trends. A trend exists when prices keep rising or falling over time. In an uptrend, each rally reaches a higher high than the preceding rally, and each decline stops at a higher level than the preceding decline. In a downtrend, each decline falls to a lower low than the preceding decline, and each rally stops at a lower level than the preceding rally. In a trading range, most rallies stop at about the same high and declines peter out at about the same low. A trader needs to identify trends and trading ranges. It is easier to trade during trends. It is harder to make money when prices are flat unless you write options, which requires a special skill. Trading in trends and in trading ranges calls for different tactics. When you go long in an uptrend or sell short in a downtrend, you have to give that trend the benefit of the doubt and not be shaken out easily. It pays to buckle your seatbelt and hang on for as long as the trend continues. When you trade in a trading range, you have to be nimble and close out your position at the slightest sign of a reversal. Another difference in trading tactics between trends and trading ranges is the handling of strength and weakness. You have to follow strength during trends, buy in uptrends, and sell short in downtrends. When prices are in a trading range, you have to do the opposite, buy weakness and sell strength. An uptrend emerges when bulls are stronger than bears and their buying forces prices up. If bears manage to push prices down, bulls return in force, break the decline, and force prices to a new high. Downtrends occur when bears are stronger and their selling pushes markets down. When a flurry of buying lifts prices, bears sell short into that rally, stop it, and send prices to new lows. When bulls and bears are equally strong or weak, prices stay in a trading range. When bulls manage to push prices up, bears sell short into that rally and prices fall. Bargain hunters step in and break the decline. Bears cover shorts, their buying fuels a minor rally, and the cycle repeats. A trading range is like a fight between two equally strong gangs. They push one another back and forth on a street corner, but neither can control the turf. A trend is like a fight where a stronger gang chases the weaker gang down the street. Every once in a while, the weaker gang stops and puts up a fight, but then is forced to turn and run again. Prices in trading ranges go nowhere, just as crowds spend most of their time in aimless milling. Markets spend more time in trading ranges than in trends because aimlessness is more common among people than purposeful action. When a crowd becomes agitated, it surges and creates a trend. Crowds do not stay excited for long. They go back to meandering. Professionals tend to give the benefit of the doubt to trading ranges.